We can remind ourselves about them. We say that the first one is called, who can remember the first one? Or just give me randomly. We have money market. Which one again? Other contractual techniques. We have money market. We have options. What else do we have? We have swaps. What else do we have? Contractual techniques of hedging. We have swaps, money market. We have options. Which one again? Forward contracts. We also have future contracts. Now, we normally have calculations ama tunagonga na hesabu on these three. We have calculations here, we have calculations here, and we have calculations here. These three normally have calculations. Now, as you can remember, we haven't finished definition, especially the options. We shall do option as the last one. I want us now to focus on contracts and money market. I want us to focus on those two, and then we shall now do option as the last one. Hiyo pia iko na hesabu and it is examinable. I'm repeating that this particular unit, this particular topic must come in exam. This one must come. At least mergers and acquisition may or may not come, but we pray that it comes. This one must come. Remember, your syllabus has got eight main topics, 8 topics. And the question that you're going to do as 5 questions, compulsory. Question number 1 is normally from topic number 1 or topic number 2. Question number 3 is normally from topic number 2. Question number 4 can be mixed up with what we just did, that is a corporate restructuring and reorganization. It can be a little bit of corporate restructuring and reorganization, and also topic number 4, mergers and acquisition. Topic number 5 normally has this one. This is where question number 5 normally comes from here in exams. It normally comes from there in exams. So I want you to pay attention, especially on these 3. These are hesabu, and they must come. At least 1 or 2 must come. 1 or 2. That will give you more than 20 marks. I believe that we have defined money markets. Did we? I hope and believe that we have defined money market. So I want us now to look at forward. I want us now to look at forward contracts, and then we shall compare with money markets, forward contracts. We have defined what it means. Under forward contracts, we say that this is where you have an arrangement to have an arrangement so that you can be able to do transaction in the future, right? And mnaelewana sahi that in the future you'll be able to do some transactions. And because of that, it involves some exchange rates. It involves some exchanges or exchange rates. So you are agreeing with somebody that in the future you can buy or sell some goods at a particular rate. And that is the exchange rate that we're going to talk about, that you're going to use in forward exchange rate. So forward involves exchange rates. Forward involves exchange rate. I want you to write exchange rate under forward because we have defined forward already. So talk about exchange rate, and then you say there are 2 types of exchange rates. There are 2 types of exchange rate quotation. There are two types of exchange rate quotation. The first one is called direct quotation, and the second one is called indirect quotation. We have direct and indirect quotation. That is under forward. Are we together? I want to define direct quotation. So start direct quotation. Direct quotation and say that under direct quotation, we are given the amount of home currency. Under direct quotation, we are given the amount of home currency. We are given the amount of home currency needed to purchase 1 unit of foreign currency. Under direct quotation, the examiner will give you the amount of home currency that you require, amount of home currency that is needed to purchase 1 unit of a foreign currency. E.g., home currency, the amount of home currency that you require, how much Kenya shillings. For example, if you are in Kenya, you say that you need how much Kenya shillings to get $1 US. Now, US dollar is 1 unit. It is per US dollar. US dollar is 1 unit. And so you need to know how much Kenya shillings, which is the home currency, that you require to purchase or to get 1 unit of the foreign currency. The foreign currency in this case is US dollar. So you say, e.g., 100 Kenya shillings to 1 US dollar. Per, this one is called per. Per means that the unit on this side is 1 single unit. This per means that you need Kenya shillings, 100 Kenya shillings for every 1 unit of US dollars. That is the exchange. So when you go to the bank, the rates that you are seeing on the bank or on the wall or on the screen, those rates are for the bank. They are not for you. So the bank is talking to you, telling you that we as the bank, we buy at this rate and we sell at this rate. They are talking about themselves, not you. Of course, if the bank is buying, it means that now you are selling. If the bank is buying, the rates that you're seeing when you get to the banking hall, those rates belong to the bank. The bank is telling you what they do. They are telling you that we buy and we sell. The opposite is true. Whenever the bank sells, it is you who buys or who buy. If the bank buy, it is you who sell. So if you go to the bank and say and find that bank buying or buying rate, buying is 100, selling is 101, it is the bank that is speaking on behalf of itself, telling you that they buy from you at 100, but they sell at 101. Of course, the selling price to the bank must be high because they need to make a profit. So whenever somebody buys anything, you always think about making profit as you sell. And that is why the buying rate will always be higher than the selling rate in normal transaction. Now, we also have a situation where you have written this one, e.g. that this, then you say, or 100 to 101 Kenya shillings per US dollar. What does that mean? For direct quotation, the one that starts on this side is normally the buying. And then this other side is selling. Buy and sell. For direct quotation. This one becomes selling and this one becomes buying. I want to say that for direct quotation, I hope umeandika hiyo, and then say that for direct quotation, banks will always buy low and sell high. For direct quotation, bank will always buy at a lower price and sell at a higher price. That is direct quotation, the one that you normally see when you go to our commercial bank in Kenya. For direct quotation, the bank will always buy low and sell high. The bank will always buy low and sell high in order to make a profit. 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 Are we together up there? Ama kuna mtu ameachwa nyuma? I'm not seeing Mercy today. I'm not seeing Florence. I'm not seeing Winnie. I'm becoming worried. Can somebody remind them that the classes have started? The class has started. So Topista, are we okay there? Rachel? Tumeelewana hapo. Under quotation, under direct quotation, there are things that you need to understand. Number one, you need to understand that the unit after per, this one is normally one denomination. Another thing that you need to understand, under direct quotation, the bank will always buy high, buy low, and sell high. So the side that is low, that is where the bank buys. And the one that is high, that is why the bank sells. I want us now to look at indirect quotation, right? Number 2, indirect quotation. Indirect quotation. And say that under indirect quotation, we are given amount of foreign currency, the amount of foreign currency needed to purchase a unit of local currency. Under indirect quotation, we are always given the amount of foreign currency required to purchase a unit of local currency. E.g., so you're going to have amount of foreign currency that you require to get 1 unit of local currency. That is indirect quotation. E.g., 30 Ugandan shillings per 1 Kenyan shillings. So we are assuming that we are in Kenya. So Kenya in this case is the local country or home. So we are given the amount of Ugandan shillings, which is foreign, that you require. You require 30 shillings, Ugandan shillings, to get 1 Kenya shillings. So under indirect, you'll be given the amount of foreign currency that you require to get 1 unit of local currency. 1 unit of local currency. This can also be expressed as 30 to 32 Ugandan shillings against Kenya shillings. It can be expressed like this. With this kind of expression, I want you to say, after putting that on your book, I want you to say that for indirect quotation, the bank buy high and sells low in order to make profit. For indirect quotation, for indirect quotation, banks buy high and sell low in order to make profit. So in that case, can somebody tell me whether that is the buying or selling? In this case, that is buying or selling? 30, is it the buying or selling? Under indirect quotation, where we have our local currency being the one that has got 1 unit, the foreign currency is here. So that is buying. Ruth is also saying that is buying. Kindly read what I've just given you. Read it again. What is it saying? Inasema aje? Yeah. It says that for indirect quotation, banks buy high. So the buying is this one. Bank buy high and sells low. So buying is high amount. So buying is here. And then this one becomes selling. Sell. Under indirect quotation. Selling, eh? Buy high, sell low. Now, those are the basics. Kama umeelewa hiyo, utakuwa na kazi rahisi tukiendelea. If you have not mastered that, you'll have a challenge. Let's look at an example now. Assume that you are given the following information, like write it, say illustration. Given the following information, given the following information, 3 months, forward exchange rate. We are talking about forward contracts, so they are forward exchange rate. Is given us 101 to 102 Kenya shillings per USD. Assume that you're given the following information. 3 months forward rate is given as follows, this one. Then they are saying that an investor, a Kenyan investor, expect to receive $60,000 in 3 months' time. From a customer in US. From a customer in USA. The first question is, what is the role of the bank? Number 2, how much in Kenya shillings? Will be received? How much in Kenya shillings will be received? So can somebody tell me the role of the bank? What will the bank do? What will be the role of the bank? I want you to understand this thing from this point. An investor will get 60,000 from UK, US. Hiyo pesa itakuja after 3 months, in the next 3 months. Now, at that point, when he receives the money, what will the bank do? Can somebody tell me what the bank will do? The bank will buy dollars from the investor. That is what Milka is saying. That is what Milka is saying, that the bank will buy dollars from the investor. Any other person? What do you think the bank will do? Kazi ya bank itakuwa nini? The role of the bank. The bank will convert to Kenya shillings. Will it buy or sell? Will the bank buy or sell? Will the bank buy dollars from this investor or sell to the investor? Remember, the exchange will take place. The exchange will take place in the country where the investor is. The investor is in Kenya, is expecting to receive money from foreign. So Kenya is the home country. Hapo ndio nyumbani. Lakini pesa itatoka kwa abroad, it will come through his account in US dollars. That dollar is not functional in Kenya. You have to change it to Kenya shillings so that you can go to the shop with it, right? So what will the bank do to this guy? The bank will buy from him or will sell to him? The bank will sell to him the dollars. Thank you. Another person to trial. Nataka tuelewe. What will the bank do? What will be the role of the bank? Na leo nataka ni unmute so that you guys can talk. Inakuwa tricky hapa. Ikifaulu ni hivyo. Edwin, na tuongea haraka because of time. We should not just take a lot of time. The answers are, it is either sell or buy. Sell or buy. Yes, Mika.
It's buying. Buying. Oh, hata wewe. They're going to receive the money in dollars, buy the dollars from me, convert it into Kenya shillings.
How that is clear? Did you guys get that? Milka, rudia.
I have said, since I'm receiving the dollars in my account, the banks will buy the dollars from me, convert it into Kenya shillings.
Thank you.
And give me the money. Yeah.
Yes. So, Ruth, what is happening here is that in Kenya you have dollar account because you know you are trading internationally. So the money will come in your dollar account. Hata ikikuja na uko na Kenya shillings account, it will go to head office, clearing house. Head office has got a department called operation or clearing. When the money reaches there, they will call you and ask you that, Ruth, your money has come $100,000 or $60,000, but you don't have Kenya shillings, you don't have dollar account. So the current rate ni hivi, wanakwambia ile rate iko. Would you wish to convert it? So the bank will take that dollar because you don't need it. In Kenya, you don't need it. Once you have received it in your account, you cannot take dollar and go with it to supermarket. It will not work. You have to go and change it. So it means that you are the one who is rich now and you now own your dollar. So the bank will buy from you. Now the dollar becomes a property. It is now the commodity that we either sell or buy. So we are going to own it because we have received it. It is a receipt. We own it. We shall go to the bank and tell the bank, oh, yes, I have received some dollars here. Can you take it from me? You'll take the bank to buy as you sell to the bank. You are selling to the bank, but the bank is buying from you. So the role of the bank, for any receipt, the role of the bank is to buy. Write a note down there and say, for every receipt, meaning that you may receive, for every receipt, the bank buys. While for every payment, the bank sells. For every receipt, the bank buys, but for every payment, the bank sells. For every receipt, the bank buys. For every purchase or payment, the bank sells. So I want you to understand. In this case, we are saying that the investor expects to receive because maybe he has sold something to US. Ameuza kitu. So I expect pesa. But we shall meet a situation where now the investor has bought some goods. Yeye ndiye amenunua vitu kutoka US or whatever country it is. The goods are coming into Kenya, so he has to send money to that country. So that is called payment. He's going to make payment for the goods that he has received. For receipt, we mean you're going to receive money for the goods that you have sold or services. So for payment, you are in Kenya and you normally trade in Kenya shillings. You have your money in Kenya shillings, but you want to pay somebody in US, you have to convert. So you'll go with the Kenya shillings to the bank and tell the bank that, excuse me, sir, I want to pay some money to US client or supplier. I need $60,000. How much can you sell it to me? I need it. Sina dollar, nataka dollar. How much will you sell it to me? 60,000. So in that case, it means that the bank is selling to you as you buy. So you tell the bank, I want to buy dollars because I don't have. I have Kenya shillings, but I want to buy dollars. Once I've bought the dollars, I'll now instruct the bank to send them to US through SWIFT or EFTs, whatever method, right? So that is why I'm saying that for every payment, the bank sells. So let's look at the role of the bank. Forget about yourself first, because if the bank buys, you sell. If the bank sells, you buy. So let's look at the role of the bank. So for every receipt, the bank buys. For every payment, the bank sells. Na hiyo imeingia. Number two, that is the role of the bank. So in this case, the role of the bank is to buy. Number two, which kind of quotation is this? Is this direct or indirect quotation? Which kind of quotation is this? Is it direct or indirect? In quotation, the direct or indirect? Just check your notes. So somebody is saying indirect. That is Edwin. Ruth is saying direct. How many are agreeing that it is indirect? Just carry up your hands. Wangapi wanakubali hii ni indirect? Yeah? We agree that tunaongea haraka haraka. How many are saying it is direct? It is direct. Rachel, where are you? Is it direct? Watu wangapi wanasema hii ni vile Ruth amesema direct? So Rachel is saying it is direct. Those are two. Well, here is one. Another person. We still have three people. Leah, Henry, Topista. Topista logged out. So we have, how many are we? Is Topista there? Yes, she's around. So Leah, Henry, why you are stunned? Just check your notes. Umeandika tu sahihi. Which kind of quotation is this? Henry is saying it is direct. Are you sure? Topista also direct. Leah? We say that the one that is on this side is normally 1 unit. So you have been given the amount of home currency because it is a Kenyan investor. the amount of home currency that you require so that you can get 1 unit of foreign. That is direct. Sasa, direct. Okay. Now, when you are now converting, so where is the buy and where is the sell? Where is the buy and where is the sell? Fanya haraka haraka kidogo. For direct, buy ni ngapi? Bank buy is low. Buy low, which is 100. Sell high, which is 1 or 2. So the role of the bank is 2. We said that the role of the bank is 2. Oh, it was 101. 101, sawa. We said that the role of the bank in this situation is to do what? So first thing that you need to know, whenever you're given this kind of question, you need to look at the question and ask yourself, is it direct or indirect? Once you know that it's direct or indirect, you need to identify which side is buying, which side is selling. After that, you need to go to the role of the bank. Role of the bank is to buy. The role of the bank you will not see from here. The role of the bank you'll see on that information where they're telling you an investor is expecting or the investor wants to pay. That is where you'll find the role of the bank. But from here, you will know. So ask yourself, where is the investor? Is the investor in Kenya or in Uganda or in the US? The country where the investor is, that is where the home currency is. So the examiner might tell you next time that a US investor wants to buy something or make payment in maybe somewhere in Canada or in Japan. They are not talking about Kenya. So how will you know the home currency? It is the currency for the country where the investor is seated. So the examiner must tell you where the investor is. They will tell you that a Kenyan investor, a Ugandan investor, a Canadian investor, or they will say a US investor. So you need to know where the investor is. That is where the home currency is. Whenever they want to trade with, that is now the foreign currency. Then you come back and ask yourself, with this expression, where is the home currency? Is it the one that has been given the amount, where we have been given the amount, or it is the one that has got 1 unit? If the home currency was this, the investor was in Uganda, in US, this would be the home currency. Kama wangesema that the investor is a US citizen and is in US, doing business in US, then that US dollar becomes the home currency. This will be indirect because now we are going to be given the amount of foreign currency that you require to buy 1 unit of home currency. Hii ingekuwa indirect, where the bank buys high, sells low. So now that we understand this, we shall do more example. So now that you know the role of the bank buys. Now you only use the buying rate, this one, and say that if in 3 months' time, that is when they are going to receive the money. They are going to receive the money in 3 months' time. At the same time, when the agreement, the deal will be maturing, the forward rate is for 3 months. So it means that this rate will be relevant at the time they will be making the pay, they will be receiving the money. So you say that if 101, which is the rate we are looking at, is equal to $1, then how much in Kenyan shillings will the investor get if the investor is paid $60,000? Itakuwa pesa ngapi? You cross multiply and say that it is now 101 times 60 all over 1. Of course, we have US dollar comes from US dollars. So the answer that you're going to get is Kenyan shillings. So it is 606,000 Kenyan shillings. Kenyan shillings. Sijui kama imeingia, tufanye ingine. Are we together there, or there is any question? Is there any question? Are we together? Kindly repeat the explanation. My net inasumbua. So where do you want me to repeat? Because I've explained a lot of things. Unataka niangalie wapi specifically? Which one? Here. I've just said that what you do, you need to know whether the bank is buying or not. According to the expression, you need to know which side is buying and which side is selling. Then now you make an expression. If the bank buys and you know that buying is 101, you now use 101 only and say, if 101 is equal to $1, but that person is going to receive 60. So you say that how much will be 60? It is 101 times 60 cross multiplication all over 1. That is 606. Okay? We shall do more explanation, more examples. I want to say that determination of exchange rates, determination of forward exchange rates under number 1, determination of forward exchange rate under number 1, premium stroke discount condition. Premium stroke discount condition. Number 2, interest stroke inflation rate parity theorem. Interest stroke inflation rate parity theories. Inflation rate parity theories. Now, you know, sometimes you can go to buy some dollars. Umeenda kubuy dollar, lakini unapata bei sio mzuri sana, maybe iko juu. So unaongea na huyo mtu, namwambia si nipe discount, apunguze hiyo bei kidogo. Now when you're buying something it is expensive, you always request for discounts, ndio. So even dollars you can also request for discount. So if the rate was given, was it with discount already ama bado? Unajua, for example, I could be selling to you something. I'm telling you that, you see, this thing we are selling at 100,000. But you are telling me that uko na 99. Ama nikuachie na 99. Tuyaona fare kurudi nyumbani. So if I sell to you at 99, this is the rate that we have agreed to exchange at. This rate it is not the correct price. The correct price should have been 100. Lakini nimekuuzia na hii ndio tumeelewana. It means that this one is after the discount. Sindio? So for me to bring it back to the correct position, if it is a discount, I need to ask myself, if it is a discount already, how much was the discount? Now you add that discount to make it correct or make it right. You add it to make it right. That is in this case. I want to say an example here. For premium, let me explain premium before we go to example. That is discount and premium. So for premium, inamaanisha it has been sold at a higher price. Tunaelewana? It is sold at a higher price. So premium is anything that is on top. If the price was 100 and I sold it at 120, the premium is 20. Means that the selling price is 120. But hapa nimekuibia. It should have been, the correct price is 100. It means that with that premium, or maybe 1,000. So I'm selling at 1020. That 20 bob is a premium. It means that I've exaggerated the price, so it is being sold at a higher price. For me to correct it, I need to subtract the premium part. The only part of the correct price, which is at 1,000. I don't know whether you're getting me. If I was supposed to sell to you something at 1,000, and I sold at 1,020, I've sold it at a higher price. Premium is the opposite of discount. Instead of going down, I sold at a higher price. It means that even though we agreed at 1020, that is not the price. The price should have been 1,000. It is only that nimekuibia. So for us to correct this, you simply subtract 20, which is the discount, which is the premium, minus that, so that you remain with 1,000. I want you now to look at illustration. Say illustration and write that Mary expect to pay 30,000 Ugandan shillings in 4 months' time. Illustration. Hizi examiner analeta. Examiner atakuletea ni discount and premium. Mary expect to pay 30,000 Ugandan shillings in 4 months' time. So Mary is going to pay somebody this amount 4 months from now. Hiyo ni around mwezi wa nane from today. The fact that they have mentioned that is Ugandan shillings, we now know that one of the countries that we are trading with is Uganda. We don't know the other country. We don't know. Unless the examiner mentions. So don't assume that Mary must be a Kenyan. Read the story again and find and ask yourself, where is Mary? Anataka kulipa hii lakini yako wapi? And then you're being told that exchange rates spot rate. And by the way, we normally have different exchange rates. Kuna hiyo ya forward, hiyo ni the rate that will be applicable at that time. Alafu spot rate is the current rate on spot. Sasa or at the spot. So spot rate is the current rate. So unaambiwa ati Mary wants to pay in 4 months time. Lakini the rates that are available sahi ni hii. So unapewa the current rate as we talk now before we start moving The spot rate is given as 32 Ugandan shillings per Kenyan shillings. So looking at the expression of the exchange rate, they mentioned that Mary wants to pay, and they are telling you that the exchange rate is Ugandan shillings against Kenyan shillings. Then now you know that it's Uganda and Kenya. And you see, for exchange to work, you cannot be in the same country where you are going to change. Haisi kuwa in Uganda, alafu anataka to make payment in Uganda, and she's worried about the exchange rate. It is not possible. So, because we are trying to talk about exchange, this person must be in a different country, and now that country can only be Kenya. Ndio maana sasa umepewa exchange rate. If she was in Uganda and she wants to make payment in Uganda, hakuna haja ya hii rate. There's nothing you are changing. So if they mention this, and again they have given you the exchange rate, that tells you that automatically Mary is now in Kenya. Haisi kuwa in Uganda, lazima ako in Kenya. So if you now know that Mary most likely is in Kenya, Mary is in Kenya, so the Kenyan currency becomes the home currency. Sawa sawa? Yes. The Kenyan currency now is the home currency because Mary is the business person, lakini ako wapi? Ako Kenya. Mahali the business person is, that is the home. That is where home currency is. So Mary is in Kenya. So now we know that Mary is in Kenya. And now when we are now interpreting this kind of equation, it is the amount of foreign currency required to purchase 1 unit of home currency. Which kind of quotation is that? Can somebody tell me? Is it direct or indirect? Where you are given the amount of foreign currency required to purchase 1 unit of home currency. Is it direct or indirect? I hope that you are seeing how we are interpreting the question. Ruth now understand that it is indirect. That is a good one. So once you have understood the type of quotation, you need to ask yourself, what is the role of the bank? It is indirect quotation. So let's start from here. It is indirect quotation. So if it is indirect quotation, where is the selling and where is the buying? Can somebody tell me the buying and the selling? What is the rule under indirect? What is the rule? The bank buys high, sell low. That is the rule. So we come here and say that now the bank buy here and the bank sell. We now know where the selling is and where the buying is. Hiyo tumemaliza. So unaenda step by step. You need to know where Mary is so that you can know the currency. Once you know the currency, look at the interpretation or the quotation or the exchange rates. Where is the home currency? Iko hiyo side. Inamaanisha this one is indirect. Now that you know that, you now ask yourself, how is the expression in terms of selling and buying? For indirect, the bank buys high, sells low. That is a rule. Number 3, what is the role of the bank when you are making payment at the payment time? Can somebody read and tell me? The bank always does what when making payment? For all the payments, the role of the bank. We are paying, we are not receiving. For every payment. The role of the bank is to sell. Why? Mary is in Kenya. She wants to sell something in Uganda, lakini hana Ugandan shillings. Itabidi achukue Kenya shillings aende kwa bank awaambie, please, I want to pay somebody in Kampala, lakini sina Ugandan shillings. Kindly, I want to buy from you. In other words, the bank is selling to Mary. The bank is selling Ugandan shillings to Mary. Now, Ugandan shillings is going to be sold to the bank. So the bank role is to sell. So the examiner can now proceed and ask you, how much is Mary going to use or to pay in Kenyan shillings? So now you know the exchange rate and is in Uganda, you say that if 1 Kenya shillings is equal to 30 Ugandan shillings, therefore, how much does Mary have to take to the bank? Sasa yeye atahesabu, inafaa afanye hesabu, ajue ni pesa yake Kenya shillings atapeleka ngapi kwa bank ndio apewe hiyo. So, in fact, it's not even 30,000 to 30, this one. So how much Kenya shillings will she take to the bank so that she can be given amount equivalent to this, so that she can be given this amount? So you cross multiply and say that 1 times 30. How much Kenya shillings is it? 1,000. Sindio? Kenya shillings. So akienda na kwa bank na 1,000 Kenya shillings, atapewa 30,000 Uganda shillings, alafu sasa tume iende huko. I hope that topesa sasa umeelewa. Sio kulewa but kuelewa, sindio? Sio kulewa. So I hope umeelewa. That is what was supposed to be given. But now let's look at this. That is if they have to sell it now, spot rate, kama wanauza saa hii. But you're being told it's 4 months time. So the examiner says that 4 months time, 4 months discount rate is 4 months discount rate is is 7 to 8. Meaning, let me say sell is here and buy is here, up and down. So meaning that here iko hivyo. Yani unapewa discount. They have agreed that the current rate is 30. Lakini in 4 months time we're going to give you a discount. Ukingoja ulipe in 4 months time tunakupea discount. So you're going to have, instead of 30, you're going to get a discount of this. And then this one, there is a discount of this. So the discount is given there. Required, determine the amount payable by Mary. So that is Uganda shillings. Determine the amount payable by Mary. That is a requirement. Required. Determine the amount payable by Mary. These amounts are cents. I should have written here cents. Cents. These are shillings, these are cents. How much cents is equivalent to 1 shilling? How much cents is equivalent to a shilling? Wale tulitumia ndururu, wale tulitumia ndururu ile wakati. Those were old as me. 100, right? So if this one is cents, convert it to shillings. Ugandan shillings. Convert, that is how many shillings? I know some of you here are very young. They don't know that we used to buy ndizi na cents. Ruth, did you manage to buy ndizi na hizi cents? Ama maembe? You didn't? Well, na 50 cents ulitumia? Kusiaga mahindi, unapeleka pale kwa tingatinga, ile mashini ya kusiaga mahindi, unaenda na some coins, 1 bob and 50 cents. So ukiwa na 3 bob, hiyo ni gorogoro mbili. Ulitumia hizo coins, 50 cents. Ulitumia kidogo. This way tunaweza elewana kilanguage. Najua kuna wengine hapa hawaelewi. Kama Jane, najua Jane haizi elewa hiyo. And even Edwin haizi elewa. So let's look at this. How many cents are here? How many shillings are here? You need to convert this to shillings. You are told 4 months discount is this. So how many shillings are here? Just type how many shillings are these? Henry, are the value of cents in Kenya equivalent to Uganda? No, these are cents in Uganda. The exchange rates are expressed in Uganda. So these are also cents expressed in Uganda. So it is Ugandan cents, Ugandan 30 bob. Sasa. So I'm asking, how many, Uganda pia wanatumia shillings. They are also using shillings, but there is a Ugandan shillings. So these are Ugandan cents. So how many Ugandan shillings are these? You simply say, Edwin, that if 100 cents is equal to 1 Ugandan shillings, then how much will 700 be? 7. So it is 7, right, times 1 all over 100. This one is the same as 0.07 shillings, right? But Ugandan shillings. So here we have 0.0, and then here we have 0.08. These are now converted to shillings because you either add it here or subtract. So you need to have them in the same currency because we are going to adjust it to this portrait, right? So you adjust here. You can't adjust when this one is cent, when this one is shillings. They are in different type of currency, many denominations. This one is shillings, this is cent. So you need to convert cents to shillings, convert to shillings. Now you can say whether you're going to add or not. We say that whenever you're given a discount and you want to get the correct figure, what do you do? Huh? We say that whenever you're given a discount and you want to get back to the correct figure, what do you do? Less the discount from the amount or add? Read what I gave you earlier. Ulisemaje? You add. Sindio? Tulisema una add. I want to say that whenever you see discount, right? Andeka hiyo chini. Whenever you see discount, remember addis. Whenever you see discount, remember addis. Addis. Whenever you see discount, remember Addis. Addis iko hivi. Whenever you see discount, remember Addis. I.e. always add discount. Always add discount. So it is add discount. Add discount. Add discount. Add discount. Add discount. Now, can we now get the correct illustration after adding the discount? What is the correct one? Topista, sorry, I'm seeing that you have a problem, you are struggling, and we are moving. We are saying that you first need to convert the discount that you're given. The discount will always come in cents, or the maximum it can be is 1 bob. Whenever you see the discount, check if they're in the same denomination as the exchange rates. These ones were in shillings, but the discounts are in cents. You need to convert the discount to shillings as well. You don't add cents direct. Itakuwa 37. So utasema ni 37 cents ama 37 shillings. It is not possible. Convert this to shillings first. This one also convert. Once you've converted, then ask yourself, is it a discount or premium? Whenever you see cents, you convert to shillings, then you ask yourself, is it a discount or premium? Then write a note there now, Topista, and say, whenever you see discount, remember Addis. Whenever you see discount, remember Addis. Addis means add discount, So it is Addis. Whenever you see discount, always remember Addis. So let's have 4 months exchange rate. We didn't have 4-month exchange rate. What we were given is the spot rate and the discount rate. We were not given the 4 months exchange rate. Now we know. Number 1, it is in cents. We have converted to shillings. Number 2, it is discount. We know we need to add so that we get the 4 months exchange rate. So our 4 months exchange rate will look like this. 4 months forward rate. Is equal to, is given us now 30.07 to 32.08 Ugandan shillings against Kenyan shillings. Are we together? Ugandan shillings against Kenyan shillings. Rachel, Leah, are we together? Let's do this step by step, because the problem is that we might not have time to go back to that. Kwa pamoja. Tuko pamoja, watu wamenyamaza.
Hii topic ilikuwa ni mchezo mwalimu. Hii topic inachanganya.
Yeah?
It's usually kind of tricky, especially when you're doing it by yourself.
Is there any person who has a challenge? You need more questions so that we can understand. Fine.
No.
It's really confusing. Fine. You'll do another one. So let's come back to our role of the bank to sell buy. So we have here sell buy. So with 30,000 in 4 months' time, what do we do? Which rate are we using? Which rate are we using? We are saying that we are selling for any payment the bank sells. So you say that if 30.07 is equal to 1 Kenyan shillings, therefore, what will 30 be? So it is 30 is 1 times 1 Kenyan shillings over 30.07. You'll be able to know how much it is. 997 and something. It should be 997. When you convert 997, sorry, 997, 20. Let me just calculate this. Was it 30 million or 30,000? Nilikupea 30,000. Niliwapea 30,000, eh? So we calculate, divide that. What do you get?
Using the 1,000 that we calculated.
Calculate, tell me the figure. Okay. Let's get to illustration 2. Thank you. $1,000 we were using before we consider the discount. 1,000 was if you were to change at the exchange rate. Kama tungeuza saa hiyo, tungelipa immediately. Ndio tulitumia 1,000 kwa sababu the exchange rate spot rate was 30. But now in 4 months time, that is when they are supposed to make the payment. So we said we need to get the 4 months time exchange rate which we were not given. So for us, we only had to do that by using the discount rate. We add it to the spot rate, alafu tunapata what the 4 months rate will be.
All right.
Get illustration B or 2. Illustration 2. Mr. B, a Ugandan expert, Mr. B, a Ugandan, jamaa anaitwa Mr. B. Mr. B, a Ugandan, expect to receive 20 million Kenyan shillings in 3 months' time. Expect to receive 20 million Kenyan shillings in 3 months' time. Spot rate is 20 million Kenyan shillings is what we expect, Mr. B. A Ugandan. Expect to receive 20 million Kenya shillings in 3 months' time. Spot rate is given as 25 to 28. 25 to 28 Ugandan shillings against 1 Kenya shillings. 3 months forward premium. Three months forward premium is given as 2, 2, 3. This one is now in shillings. Ugandan shillings to Kenyan shillings. Not cents. Not cents. Ukipewa cents, work with cents. This one umepewa shillings. Right? So let's calculate that now and find out how much in Ugandan shillings will Mr. B receive. How much in Ugandan shillings will Mr. B receive in 3 months' time? Required, how much will Mr. B receive in 3 months' time in Ugandan shillings? So the first thing that you do here, as usual, we need to ask ourselves, where is Mr. B? He is in Uganda. So which is the home country? Which is the home country? Natuongea haraka haraka. Which is the home country? Home country ni wapi sahihi? Aha. Kenya. Aha. Which is the home country? Thank you. Any person with any contrary opinion? Home country for this question? Huh? So Melka is saying that the home country is Uganda. Edwin is saying Uganda. Yes, Ruth. And Topista. And Leah. Wale hawajapeana answers wote. Home country is the country where the business person is. We are told that the business person is in Uganda. He's a Ugandan and he expects to receive Kenya shillings, meaning that ana receive kutoka wapi? Haizi receive akiwa Kenya. Ukiambiwa tu expect, it is a receipt. In which currency? Receipt is in Kenya shillings. He is in the opposite country, the other country. So if the exchange rate shows that we are having Kenya trading with Uganda and the receipt is in Kenya shillings, definitely haizi receive Kenya shillings akiwa Kenya. Ata receive akiwa Uganda. So this Ugandan man is definitely in Uganda. Therefore, Uganda is the home country. It is the home country because that is where the business person is. That is the first thing. Number two, after knowing that Uganda is the home country, which kind of expression is this one? Is it direct or indirect? It's direct. Why? Because in this question, we have been given the amount of home currency, which is now equal to 1 unit of foreign currency. Kenya becomes the foreign. So you are given the amount of Uganda, which is now the home currency, that you need to buy 1 unit of. So this one is direct quotation. Tuko pamoja? If it is direct quotation, what is the role of the bank? Step, inaenda hivyo, step by step. What is the role of the bank? For every receipt, the role of the bank is to buy. And the bank buys how? Low or high? Role of the bank, we know. Role of the bank. We can write here. Here to show you. For every receipt, the role of the bank is, role of bank is to buy. The bank buys high or low. The bank buys low and sells high. So the bank will buy here. So the role of the bank is to buy and sell. Yani umepita hiyo hadi. That step umepita. The next step now you are coming to is that we don't have 3 months forward rate. We don't have. What we are given is the spot rate and 3 months forward premium. We say that for every premium you do what? For premium we do what? So that we get 3 months forward rate. For premium we less. Thank you. For discount, always add this. For this, there are only 2 things: premium and discount. So you less here. When you less, what are you going to have? We're going to have this one. They are in the same denomination, shillings. So you don't need to convert. Come and get what cents. Then we change this one to cents. That will be 0.02. Now we less from here. But this one is both, they are both shillings. So just subtract and get here now. This one is 23 to 25. Ugandan shillings against Kenyan shillings. We are doing the same thing. So I hope wale walikuwa nasema ati turudie, sasa tumeelewa. So that is how the exchange rate works. Now this is the rate that you need to use. The 3 months forward rate. Premium achana nayo. Spot achana nayo. They only help you to get the correct one. If the examiner has given you the 3 months forward rate, fine. And in some cases, the examiner can give you 2 months forward rate, 1 month forward rate, and 3 months forward rate. Ask yourself, those rates that you're going to be given can be even 3 of them. 3 months forward rate, 2 months forward rate, 1 month forward rate. But ask yourself, when is this person going to receive the money? 3 months. Forget about other rates. Consider 3 months forward rate only. This is again, assume that you have not seen. Maybe there is another question for them. Lakini hii naye yenye unajibu, they want you to do it 3 months time. So match 3 months with the rate for 3 months. Don't exchange the rate for 2 months. Kwa sababu hiyo rate ya 2 months itapata kama pesa haijafika. Now, we have this. We know the role of the bank. So we're going to receive. If you're going to receive, the bank will buy from us. So we use the buying rate. And now you say that if 23 is equal to 1 Kenya shillings, then how much are we going to receive? Sisi kama Uganda, if we get 20 million in the bank, which is a Kenyan shillings, how much is it going to be in Uganda shillings? So this one you say, cross multiplication, this times this, all over this. So we're going to have 460 million Ugandan shillings. Is it right? This times this, all over this. 460 million. Let's look at the last illustration, and then we can now rest for today. Hapa ndio ilikuwa ngumu, na uende revise because now tomorrow tutashika hivi mbio sasa. I'll assume that umeelewa. So enda urudie tena the rules. Let's look at another question here. Call it illustration 3. Illustration 3. It says that Mrs. C expect to receive $200,000, 2 million US dollars, USD, 2 million US dollars, 2 million US dollars in 3 months' time. Spot rate, which is today's rate, is given us 100 Kenya shillings against 1 US dollar. Inflation per annum in Kenya is 14%. Inflation per annum in Kenya is 14%. Inflation per annum in USA is 5%. How much in Kenya shillings will Miss C receive? How much in Kenya shillings will Miss C receive? Any person who wants to try this? Kuna mtu angependa kujaribu hii? Who wants to try? Niwape time, mjaribu. Let us do it tomorrow. Tusifanye sahi. Ruth, leo ni kama umechoka, nimeona leo hauna muda. Leo hauna mood kabisa. Kabisa. How do we treat inflation? Confused already. So she's saying that it confused. So let's look at this tomorrow. So this one comes from something that is called purchasing power parity. And interest rate parity. Mshasikia vitu kama hizo. So that is what we shall look at to solve this one. So this question is from number 2. We say that determination of forward exchange rate under premium stock discount rate. Number 2 was interest and inflation. Now inflation, this one is inflation, and the secret is secret, or you can say prediction. Use, because it is inflation, use purchasing power parity. Use purchasing power parity. So we shall use this tomorrow. And because I don't want you to get confused more, I'm giving you time to go and revise what we have done. So tomorrow tutaanzia hiyo, kishamaliza hiyo, and now we go to some 2 examples, then we go to money market. So let's pick from there tomorrow. Hapo siri ni kutumia purchasing power parity and interest rate parity. Go and revise what you have done today. Have a good night.